Chris, why do you think the shares are moving lower?
Yeah, I think it's a combination of two things. I think first, it is a bit of an earnings miss when you adjust for the tax benefit that they reported. So it came in at $1.74, 6 cents below the street and us. And then the second thing is, I think the guidance is good. It's in line, but you got to put it in the context that this company had raised their guidance for the full year 2018 back in October. So I think expectations were that they would beat for the quarter and then maybe guide to a number that was above where consensus is for 2019.
Colin, your own take?
Yeah, I mean, revenue came in modestly below our forecast, but I mean, the thing that we're looking at most closely is the rewards environment. Rewards really is what drove expenses higher during the period, and really where most of our concerns are over the next few years.
Why? What's happening on the rewards front?
Well, the rewards environment, it's really heated right now, and despite some talk of it cooling off in recent months, we've really seen no signs of that. American Express's larger competitors are using rewards to really access customers and sell them additional products, whereas American Express really doesn't have the same ability as a monoline issuer.
Yeah.
Chris, we did see provisions go up as well during the quarter. Is that something you're worried about? I guess for most of the bank's earnings, we didn't really see any risk of worsening credit quality. Is this something you're focused on for Amex?
It is something we're watching closely. For us, the provision was a little bit higher than we were expecting, but I don't think it's a cause for concern. American Express is growing their loan book faster than other U.S. card issuers. But I would also say I think they've got a lot of runway because for all the spending they do, they have actually a pretty disproportionately small share of loans. So I think they've got a ways to go before we really get concerned. And we haven't seen it in their monthly data either, that any problems in terms of net charge-offs.
And Colin, I mean, aside from the rewards expense, essentially making their customers a bit less profitable over time as that arms race continues, what do you think about how it's positioned just relative to where the economic cycle is? Because it seems to me what's been dogging a lot of the card issuers is just this sense that, look, we've seen the best we're going to see for credit loss provisions, and maybe the consumer is strong now, but how long can we bank on that? So does the stock have a discount for those reasons?
Perhaps. I mean, yeah, American Express is growing faster later in the cycle than some of its rivals. But, I mean, we look at the credit quality data and we see pretty steady delinquency data, which is really the best forward indicator for charge-offs. So it's, even though they're maybe taking a little bit more risk later in the economic cycle, it's not something that greatly concerns us.
So would you buy the stock? Here, it's down 3% on a narrow miss.
So it's trading at a modest discount to our fair value estimate of $110. So, I mean, it's modestly cheap, but we think there are probably less or greater discounts out there amongst some of American Express's rivals.